In just 10 months, Donald Trump has done what no other US president has managed in the past half-century, and the country will be paying the price for it for a long time to come. He has increased the national debt by a staggering $1.6 trillion, setting a record for the fastest debt buildup in modern history. In July alone, his administration spent $291 billion beyond the budget. In less than a year, America's finances have been drained at a pace not seen in 50 years. Trump has outspent all modern presidents while insisting he is saving the economy. In reality, this is reckless borrowing that will burden taxpayers, businesses, and families for decades ahead. The hardest part is grasping the gap between words and numbers. While he talks about making America great again, the statistics show the opposite. The country is sliding toward bankruptcy faster than anyone could have imagined. And the deeper you look into the figures, the more alarming the picture becomes. And the story only worsens. On July 28th, the US Treasury quietly released data that landed like a financial bomb. By the end of 2025, Washington will need to borrow another $1.6 trillion in net market debt. And this is not money for long-term projects or emergency measures. It is fresh borrowing piled on top of an already crushing mountain. The reason is simple. The federal government spends far more than it earns. In the first 10 months of the fiscal year 2025, the budget deficit has already reached $1.6 trillion, which is $109 billion more than during the same period of 2024. If this pace continues, by year's end, the deficit could exceed $3 trillion, breaking modern records and pushing the country into a dangerous, uncharted financial zone. The borrowing schedule is already set. From July through September, the Treasury will issue at least $1 trillion in new debt. From October through December, another $590 billion. And that is only net borrowing, not counting the trillions that will have to be refinanced to cover old obligations. It is like paying off one maxed-out credit card by taking out a new one and then opening another just to keep the lights on. Part of this money will go into the government's main operating account, the Treasury General Account. By year's end, it is projected to hold $850 billion, almost twice the current level. But in reality, only between $400 and $500 billion will actually get there, while the remaining $1.2 trillion will vanish into current spending, because tax revenues simply cannot keep up with obligations. The White House likes to highlight tariff revenue, claiming it brings stability and strength to the budget. Yes, in July, tariff receipts topped $20 billion, but even with that boost, the monthly deficit grew by nearly 20% compared to last year, reaching about $291 billion. That is because spending on Social Security, healthcare, and especially interest on the debt is rising far faster than tariff revenue. And interest is no longer just a side problem. The total US debt has already surpassed $37 trillion, much earlier than forecasts made before the pandemic, and is now rapidly approaching $38 trillion. Every new loan locks in the obligation to pay interest in the future, and no tax tweaks or short-term trade maneuvers can change that arithmetic. Servicing the debt will consume an ever larger share of the budget, leaving less and less for everything else, regardless of who sits in the White House. Tariffs may draw applause at rallies, but they cannot fill a hole of this magnitude. The real danger lies in the speed at which the debt is growing. If borrowing is accelerating this fast in relatively calm times, what will happen when the next crisis hits? That is when interest rates will spike, revenues will fall, and the fragile balance could collapse within weeks. For now, month after month, Washington is spending and borrowing more than in 2023 and 2024. The only exception was June, and even that was just a statistical pause before the next surge. Today, spending and borrowing are already on par with the COVID-era stimulus of 2020 and 2021. The difference now is that there is no pandemic, no disaster, no extraordinary reason. This is ordinary government operation, and it is burning through money faster than ever before. The numbers speak for themselves. In January 2024, the national debt was $34 trillion. By July, 35. By December of the same year, 36. And now, in August 2025, it has already crossed $37 trillion. That is roughly an additional $1 trillion of debt every 5 to 6 months, nearly twice the average pace of the past 25 years. The debt curve is not just climbing, It is accelerating. This leads to a chain of consequences: a drop in credit rating, rising interest payments, and loss of policy flexibility. Even in months when tariffs bring in more revenue or a tiny surplus appears, the effect is barely noticeable. Obligations and interest grow simultaneously, instantly consuming those crumbs. This is not a static picture, but a time lapse where the numbers blur and the trajectory shoots upward more sharply. And if nothing changes, that trajectory points to collapse. What is especially worrying is the growing burden of interest payments. By projections, by the year 2034, 29% of all federal revenue will go just to interest. That is more than $2.2 trillion per year. It means that nearly 33 cents of every tax dollar collected will be spent servicing old debt before anything is left for schools, the military, roads, or anything else. And the mechanism works without mercy. Every dollar borrowed today automatically turns into a stream of interest payments for many years ahead. This borrowing surge is not just a one-year budget issue. It is a debt obligation that will define the economic agenda for decades to come. And unless serious steps are taken, the Congressional Budget Office estimates that in the coming years, annual interest payments could already surpass $1 trillion. Such a weight will crowd out investment from the economy, slow growth, and leave the United States with less freedom to act when the next economic storm arrives. The question is no longer whether the country can live at this pace, but what will happen when the system faces its inevitable stress test. If even in relatively calm times interest is already devouring an enormous share of revenue, what will happen in a crisis when tax receipts plunge and borrowing costs spike? It may seem the solution is simple: stop borrowing, cut spending, and balance the budget. But in practice, it is far more complex, tied to the very structure of the American economy. Every dollar in circulation is someone's debt note, and every such debt requires interest payments. If the government suddenly stopped issuing new bonds, the money supply would begin to shrink. And when the supply of money contracts, the economy does not slow gradually. It can collapse into a true deflationary spiral. The word deflation often sounds positive: prices falling, goods getting cheaper. But in reality, it is economic poison. When prices drop, business revenues fall, companies cut wages or staff, people spend less, demand shrinks further, profits vanish, and the economy begins to consume itself. This is exactly what happened during the Great Depression. It was not only the stock market crash, but the prolonged fall in prices that turned financial panic into a crisis nearly a decade long. Meanwhile, the debts did not disappear. They still had to be repaid, but now in a shrinking money environment. For decades, the United States avoided that cliff by constantly expanding the money supply through new borrowing, and this was done under every administration, Republican and Democrat alike. But today, that cycle has entered a much more dangerous phase. The debt is not only growing rapidly, it is growing without a clear long-term strategy, and the entire world sees it. In May 2025, Moody's, the last of the three major rating agencies still granting the US a AAA rating, downgraded it to AA1. This is not just a line in a report. It is a signal to global investors that American bonds have become riskier. And increased risk almost always means more expensive borrowing, not only for the government, but also for businesses and citizens. We often hear that America is the richest country in the world, but headlines rarely mention that the United States owes enormous sums to foreign governments, and those governments earn billions of dollars each year from it. Today, the three largest foreign holders of U.S. Treasury bonds are Japan, the United Kingdom, and China. Each of these countries owns securities worth hundreds of billions of dollars. In effect, they are America's biggest lending companies, collecting interest while knowing that Washington is in no hurry to repay the principal. The scheme works in their favor. The more the United States borrows, the more interest flows into Tokyo, Beijing, and London. And all of this in dollars, which remain the world's reserve currency. When the US credit rating falls, as it did in May 2025, borrowing rates rise. That means even larger flows of money leaving the American economy and filling foreign treasuries. The deeper the debt hole, the more they profit. And all this without passing a law, imposing tariffs, or using military force. At the same time, they are far from passive investors. China has already shown that it can use its holdings of US debt as a tool of pressure. Even a hint that Beijing may slow down or halt purchases of treasuries makes Wall Street nervous and puts Washington under pressure during trade disputes. Japan, too, benefits from America's dependence. It supports the yen's exchange rate and strengthens Tokyo's position in trade and security negotiations. Behind all the patriotic speeches and flag-waving lies a simple truth: America's economic engine runs on borrowed fuel. A significant share of that fuel comes from countries with their own interests and ambitions. Every new borrowed dollar tightens their grip, and every payment sent abroad is a reminder that global influence can be exercised not only with armies, but with credit. And the more the United States depends on this inflow of foreign capital, the less freedom of maneuver it has when creditors decide to use their accumulated leverage. The question now is when that moment will come. Will America be able to choose its own course, or will it have to discuss its future at someone else's negotiating table? To stay up to date with the latest developments on the global stage, subscribe and turn on notifications. See you in the next video.